Is this a good time to invest?
So it's a question that we received a little while ago about finances, and it says, it feels like you are suggesting that the market going up is a good thing. It is instead a huge tragedy if you have an investment horizon of more than right now and keep investing regularly over time, which applies to most of us.
Okay, so if you're watching on YouTube, I'm going to show you a few slides here, and hopefully you're looking at them now. This is in some ways an amazing question because it shows quite a deep level of understanding about investing, but it also shows something about investing which I love, which is that if you overcomplicate investing, you just end up doing worse than if you just follow the strategy which we espouse here at Medics Money. So what is Simone Brucci 9793 talking about here? I made a video saying how much I made from my investments last year. 2023 was supposed to be a terrible year for the stock market because we had inflation out of control, interest rates out of control. We had at least one or maybe two wars by that time, I can't remember. And yet the stock market still went up. So the concept of unpredictability is what we're talking about here. Nobody can predict the future with the stock market, and that has been proven time and time again. Okay, so what Simone Brucci is saying here is that if you're at the start of your investing career and you had the opportunity to buy a global stock market index, which is an index of the best companies in the world, if you could buy that at a 30% discount, of course you would love to, okay? Because it's a 30% discount in the sale. If there's a sale at your local shoe shop and it's 30% off, there's a queue out the door, okay? But then when the stock market's got a 30% sale on, not many people are buying. And so of course the concept here is sound. You're buying a slice of a global index, and if you can buy it when the market is down, i.e. in the sale, that is a perfect scenario, okay? And here's two charts I just wanted to show you, okay? So this is the S&P 500, which is a global stock market index of the 500 biggest companies in America. So if you had bought the S&P 500 on the 14th of February 2022, right now you would be 52% up. Let's say 53% up. Where's my manners rounding that down? So 53% up, all right? But let's just imagine that you had a crystal ball and in some way you'd waited and correctly anticipated that there would be a global pandemic and that would crash the stock market very suddenly, okay? And then instead of buying on the 14th of February 2022, where you made 53%, you bought on the 20th of March 2020, okay? So only like a month later. If you'd have managed to do that, you would not be 52% or 53% up, you would be 123% up, which sounds really appealing. It sounds like a no-brainer, doesn't it? It's like the common question we get is, should I start investing now or should I wait for the market to crash? Of course, in an ideal world, if you could tell me when the market's going to be down 30%, I'd save up all my money and buy it then because I'd be buying at a 30% discount. But in reality, no one has a crystal ball. No one can predict what the stock market will do. And last year, everyone was saying the stock market was going to do terribly. Of course, I just ignored that advice, and so did Ed, and so did my children, and so did my partner. And we just carried on investing every single month automatically, ignored the noise because no one can predict the future. And we made 15% last year, okay? The concept of this question is sound, but unless you have a crystal ball, you're never going to be able to do market timing, okay? And the 14th of February 2020, the reason why I chose that date is because that is actually the date that, it's a romantic day, of course, Valentine's Day, but that's not why I chose it. That is the date that my youngest daughter opened her junior stocks and shares ISA. So she was born in December, things were hectic. I didn't get around to investing stocks and shares ISA until February, and she literally bought on Valentine's Day, which was the worst possible time to buy. But still, in the long term, she's massively up. Versus if I just waited until, I don't know what I'd be waiting for, I might still be waiting. So even though my youngest daughter bought at the worst possible time, she's still 53% up or more. So market timing is incredibly hard. And let's just look at this other chart, which I love, okay? Which just reinforces the concept that instead of waiting to invest, you should just start investing as soon as you can and use what we call pound cost or dollar cost averaging by putting in regular small amounts via direct debit automatically and just invest automatically. Anytime something's automatic, it becomes a habit. Brushing your teeth, you do automatically as part of your routine. I am trying to go to the gym and do yoga automatically, and it's slowly becoming part of my habit, so that's good. So look at this. This just shows if you invested $10,000 between January the 3rd, 1995, and December 31st, 2014. So if you did nothing, and by nothing, I mean you didn't try and time the market, you didn't try and predict when it was a good time to buy, you just banged it in on the 3rd of January 1995, and then the 31st of December 2014, you would have $65,453. Nice, okay? But let's just imagine you thought, well, that makes no sense just doing nothing. Like, you can't just make money from the stock market by doing nothing, surely. I'm going to try and time the market. So I'll sell when the market's high, and then I'll rebuy when the market's low. So if you did that, and in that time period, you just missed out on 10 of the best days, instead of having $65,453, you would have $32,665. So a massive hit, okay? And that's only by missing 10 days. Let's just imagine that you miss 20 days. Your return goes down to $20,000 and so on. So to the point where if you were really cautious and you got really scared and you stayed out of the stock market for 60 of the best days, instead of getting £65,453, you get £4,570. So when we say buy the right fund, match to your risk tolerances and preferences and your goals, and then just do nothing, this is why we say do nothing, okay? And I think this little caption here is why it's so hard to predict what the stock market's going to do, because let's just imagine that you see the stock market going down and then you're like, this is the time, this is the peak, I'm going to sell and rebuy later. Well, 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So unless you're monitoring the stock market every single day, which clearly as a doctor or healthcare professional you don't have time to do, you're going to miss out. So this is actually great news for investors like us, because doing nothing and just pound cost averaging into a portfolio that matches your risk tolerances and preferences outperforms most other investors who are trying to time the market and guess what to do. And to my point about another reason why timing the market is hard, like I said, if there's a sale on at your shoe shop and it's 30% discount, everyone loves it, okay? And they go and buy. But that is not what stock market investors do. When there's a sale on in the stock market, everyone looks at how much money they've lost, panics, and sells. So they're effectively buying high and selling low, which is just a guaranteed way to lose money. And this chart is complicated, but basically it shows the stock market level versus the inflows and outflows. So above the blue line is an inflow, people buying, and below the blue line is selling. And as you see by these red boxes, as the market bottoms out, the fear is absolutely maximal, and people think, oh my goodness, I've got to sell. This time it's different. They sell right at the bottom. So we know that investor behavior is one of the biggest contributors to destroying your long-term returns. And it can be hard to accept that buying and holding and literally doing nothing, as I've outlined on many YouTube videos, is the best strategy. But actually, the data shows us that as soon as you introduce decision-making and, more importantly, human emotions, you start to make mistakes. And I've talked about how I deal with the emotions of investing in the past, which is essentially by never looking at my portfolio and setting up a direct debit every month in order to invest. So does that make sense, mate? It's pretty complicated. That's a great question, which shows a really deep understanding of investing, but you might be overthinking it a bit there for reasons that I've hopefully outlined.
Yeah, I think that make perfect sense, absolutely. And yeah, likewise, I just keep investing passively every month. I just transfer some more money into an ISA, basically. And yeah, it made perfect sense. Yeah, absolutely great question. And yeah, we love answering questions about investing and finance and tax. Please do keep up asking us questions.
Brilliant. Okay, so we love doing these Q&A episodes. We're doing more of them because we're getting feedback that you like them. But if you're on YouTube, if you want more Q&A episodes, give us a thumbs up. Okay, in the comments, and then we'll know. Also hit the like button, also hit the subscribe button. If you're listening on the podcast, it's not easy to ask questions on the podcast, which is why we like YouTube, because it's got that interactivity. But yeah, maybe head over to YouTube and ask your questions. Thank you so much for listening or watching if you're on the podcast, and see you on the next episode.
Yeah, thanks guys.